Hello and welcome everyone to our podcast series Money Matters on money banking and central banking by the Institute of International Monetary Research. The purpose of the Institute is to demonstrate and bring to public attention the strong relationship between the quantity of money on the one hand and the levels of national income and inflation on the other. I am Damian Pudner, Director of the Institute, and today my guest is Chris Marsh. Chris is Chief Economic Advisor to Exante Data and blogger under the General Theorist on global macro, central banks, and finance. Chris holds a PhD in International Macroeconomics and has worked at the International Monetary Fund and in finance. Chris, welcome. It's really great to have you with us today.
Hi, Damien. Thanks for having me.
Pleasure. So today we're going to discuss the European Central Bank, which is very timely given the ECB rate decision was announced yesterday. Before we start and jump into some more broader discussion on ECB monetary policy, we saw them hike rates 25 basis points yesterday, which many would argue was against a market looking for a pause, at least prior to this week's leak to Reuters. What are your initial thoughts on the hike? Are they done for this rate cycle? And I think it's fair to say that the press conference yesterday was a little confused, for lack of a better word. What's going on with the forward guidance currently being offered by the General Counsel?
Yeah, well, I think that the whole process around this meeting was a bit more confused than usual, and I think that what's going on here is that the political or the decision making has become increasingly politicized, right? So I think for the past year and a half or so, as inflation was accelerating, it was quite easy to get a consensus that rates had to rise and they had to get somewhere close to sort of the neutral rate. And we always knew that it was going to get tricky once they got to the point where the rates were roughly neutral and they were going to move into sort of a tighter policy stance. And so for quite a while now, it's been clear that there was going to come a point where the doves and the hawks, who could kind of agree to the policy decisions until a certain point, would eventually face off and basically oppose each other. And so there was a kind of a sense that this was coming, because back in July, when they had the meeting, in the minutes from the July meeting, they confirmed that they sort of agreed between themselves, look, let's stop talking about what we're going to do next. Let's just focus on the data dependency and let's not start fighting out in advance of the meeting what we're going to do. And so strangely enough, you had a really important meeting and you had no guidance or limited guidance from the governing council members as to what their thinking was in terms of rates, in terms of what to do next. But I think if as we did and ahead of this meeting, if you go through the list of the governing council members and just rank them on a hawkish and dovish scale, I think that you can count more hawks than doves. So when push comes to shove, if the hawks wanted to push through a hike, I think they always can at the moment. And so I think there was a danger of a surprise this meeting, because they hadn't communicated as clearly as normal. And because they had, and you got this political stuff going on where the hawks are trying to push through the hikes. And so we got to Monday this week, and I think there was probably, or maybe Friday last week, there was only 1/3 chance of a hike priced. We thought that was too low. And then, of course, throughout the week, and then on Tuesday, the pricing repriced sharply until we got the leak on Tuesday night, and at which point I think there was maybe 75% of a hike priced in by Wednesday morning. So it's been messy, put it that way. I'm not sure whether this is how the governing council should be behaving, but we are where we are. And as to the communication in the meeting, I think this just reflects the fact that you've got these two groups on the council. One set are still hawkish, want a hike. The other group, in exchange for the hike, got the concession that there was a hint at a pause. That we're not going to need to hike anymore. And so you've still got this tension within the governing council, and Lagarde, being a political animal, has weighed those two sides, and one side wanted the hike, the other side didn't. And so that compromise actually came across very dovish for the market, because now the market thinks that the hikes are done. I think probably the hikes are done, but if inflation doesn't behave by December, the hawks will be back. So it's an interesting setup.
It is, and I think there were some comments out in the FT today attributed to some of the General Council members that, a December hike is not off the cards if, as you say, there's a negative surprise to inflation going forward. Maybe October is off, but December's on the table potentially.
Yeah, I think that's about right. I think probably the only redeeming feature, if you like, at the moment is that their inflation forecasts are actually reasonably conservative for the first time. I think it hasn't been the case for most of the past 2 years. The inflation forecasts have always been behind the curve. but we're probably about right now. So it is going to be harder for them to overshoot the inflation forecast from here. In which case, the December hike really is unlikely at this point. But of course, as inflation has surprised us so many times in the last 2 years, we should be cautious and keep an eye on the data.
No, of course, of course. Okay, thank you. And so moving on, the unconventional monetary policy tools, such as quantitative easing, that have become accepted as part of the ECB conventional policy toolkit now, along with other central banks. Do you think that QE, once seen as this kind of nuclear option of monetary policy, should have stricter guidelines on when it can be used, what size it can get to, how quick it can get to that size, the terms of its exit, etc.?
Well, I'm sort of anxious so that I think central banks shouldn't be too constrained in advance in terms of the policy tools that they can access. So part of me is sort of slightly nervous about the idea that QE is getting a bad press because even if we're experiencing a period of inflation and so forth, I think we would want the central banks to have all the tools at their disposal in the event that they're needed in the future. I mean, in the case of the UK is an interesting one, right? Because in the UK, every time the Bank of England wants to access or increase the asset purchase facility, they have to get an indemnity from the Treasury. Now, if QE and if the Bank of England's previous policies become politicized, and it becomes the idea that that this is costing taxpayers money, if that becomes a part of the narrative, then it will be harder for some future government to sign off on the asset purchase facility from the indemnity perspective. So it worries me about tying the hands of monetary policymakers. So on the ECB in particular, then, I mean, oh, by the way, so just to sort of go slightly off on a bit of a tangent, right? I think in the euro system, the nature of QE and the nature of balance sheet expansion is different because it plays an important role in terms of the balance of payments within the euro system. So in a sense, this includes the target 2 system, right, which is part of the balance or the balance of payments within the euro system when there's sort of changing exposures. And the target 2 system plays this role because, sort of in a way, what it does is for creditors, it allows creditors to reduce their exposure to the periphery or to the debtor countries. And they sort of dilute the risk in the process. So they have a risk on the periphery, they can convert it to a risk on the euro system, which is de-risking from their perspective. And from the debtor's perspective, this buys them time for external adjustment, but it also plays a role in the external adjustment, right? So essentially, by converting external liabilities into target 2 liabilities, they convert them from some fixed flow, some securities, fixed income flows into a floating rate on the target 2 balances, which was 0 until recently. So in a way, the Eurosystem balance sheet is not just a normal balance sheet of the other central banks. It's kind of part of the balance of payments adjustment within an imperfectly formed currency union. So from the perspective of the Eurozone, it's much more complicated to think about how you should think about QE in the future, because it relates to these sort of potential asymmetric shocks that can happen within individual countries or within regions within the Eurozone. So I'm anxious that there shouldn't be too many limits on what central banks can do and what the euro system can do. Having said that, the constraints at the moment on QE are already pretty harsh from the euro system perspective, in that you have to buy according to capital key under normal circumstances. So there are already limits on QE which make it unworkable from the perspective or less strong from the perspective of managing the balance of payments that I'm talking about. So my answer to that question is not a very good one, but it's that we shouldn't constrain central banks too much for future actions. On the other hand, I think we've learned that QE doesn't necessarily impact the way we'd hoped, which is through inflation. What QE does is it resolves financial instability problems first and foremost and prevents deflation risk. But I don't think it generates inflation in the way that we'd hoped, which argues for doing less QE than we have in the past. But on the other hand, we don't know what's coming, so we shouldn't be too constrained. That would be my answer. Not necessarily satisfying answer, though, Damian.
No, you raised some very good points there. Not all QE is created equally. The US Federal Reserve, the Bank of England, and the ECB, you quite rightly point out, all have slightly different ways of introducing QE into the system, and we don't know how each transmission channel is going to work, and even less so how it's going to work in reverse now that we are entering a period of quantitative tightening as well. So, very good points to make on the target two balances, I think. If I could just move on then. So, the structural changes to the drivers of inflation over the last 2 decades have seen a period of low and stable inflation, this so called great moderation. Recently, there has been a vocal number of economists and market commentators questioning the 2% inflation target of central banks. In July 2021, the ECB obviously concluded its strategic review and decided that price stability is best maintained by aiming for 2% inflation over the medium term. Do you think there is a case to be made for a temporary or indeed long-term change to the 2% inflation target of central banks, specifically in relation to the ECB?
Well, I think the temporary one, I think is not a good idea in the sense that the inflation targeting framework already provides the sort of, if you like, the flexibility for central banks to communicate when they facing periods of above target inflation and to explain that to the public. And I think what's lacked during this cycle of inflation is the clear communication and the sort of strategy by central banks to explain why we've got this inflation and why it should be a temporary period of over target inflation based on the adjustment to the stocks imbalances from the pandemic and then the energy shock. And so central banks should be proactively allowing this flexibility to overshoot inflation targets and explain it to the public. As for the long run, as to the sort of whether there should be a permanent change in the inflation target, I buy the argument that I think we have been too close to the effective lower bound on rates, and so I buy the argument that a higher inflation target is reasonable to try and avoid circumstances where we have to push against the lower bound again. The problem with this is how do you do that politically? What is the process to make sure that this doesn't become a political football that gets kicked around every time there's an election cycle or so forth? And that's the problem, right? Ultimately, how do you decide these things? In the UK, for example, it would be nice to put it to some apolitical process that reviewed the target and came up with an answer. But once you enter the euro system and the eurozone, the number of countries involved, the number of different constituencies, each of whom has something to say about this, it becomes unworkable to make changes. So I think that ideally, maybe you could aim for something like closer to 3% for the euro system, but practically it's impossible to see how they can ever get there.
No, I would agree with that. I mean, trying to get agreement in all members of the within the ECB, different central banks is going to be very difficult in any case. I did see that Italy Deputy Prime Minister Matteo Salvini came out yesterday or this morning and said that the umpteenth mess made by the ECB in raising rates yesterday, and Lagarde is living on Mars. So you can see how already that the difference between some of the northern and southern states on what happened yesterday.
Yeah, exactly. It's becoming more political, actually. So
Yes. So I guess I was going to follow up with a question on: do you think there was going to be a case for undershooting the inflation target below 2% now that we've had this above target period? This average inflation target, or akin to what's in the US, I guess. Although I would be hesitant to say that the Federal Reserve would look for a period of below 2% inflation anytime soon. Do you think there's any chance that any of the ECB members looking for a period of below 2% inflation?
yeah, I think there were some who may try and make that argument, but I think it's very unlikely that it will happen. I mean, I think the problems are two, right? The first one would be, well, if you push below target for a while, then you're risking embedding inflation expectations lower, and then you're risking the period of being stuck up against the lower bound again. So from a risk management perspective, it's something that should be avoided. But I think also, if you were sort of in the hawkish camp arguing for this, you should be pretty careful because there's still a lot of catch up, if you like, from undershooting of target in the past decade. So if you're on the dovish side, you could point to that and say, well, we've still got X percentage points to catch up since 2010. So let's not worry about the last 2 years. So I think once you enter that sort of set of arguments, you're opening up like that proverbial can of worms. So I think they'll all avoid it, but I think for good reasons to avoid it.
Okay. Okay. So if anything, maybe it's the opposite and allowing the economies to run slightly hot for a period of time, given the decade-long historical basis of where inflation has been.
That would be my argument. Yeah, I mean the interesting thing about the strategy review is how much they emphasize the symmetry of the target, whereas I think there should be an asymmetry in favor of being slightly above target, given the risks once you slip
Right.
below of slipping to the lower bound. So they emphasize the symmetry, and the symmetry means that as well as pushing against the undershooting, they should be reactive to overshooting, and that's what they've done. They've stuck to that. But from my perspective, the risk of over tightening means pushing you below the inflation target again, and that would be a problem from the lower bound perspective.
Okay. Okay. Moving on, is it appropriate for the ECB to prioritize non-monetary issues such as climate change and green policies, considering the potential inflationary consequences and impact on its primary mandate of the 2% inflation target over the medium term?
Yeah, well, it's kind of part of the current trend, right? The central banks want to be at the forefront of every policy issue, but it seems to me that central banks have been drawn way out of what should be their core focus, right? And so I don't really understand why the climate change issues are becoming such a focus, in the sense that maybe society needs to acknowledge that these are global problems that require everybody to play a part in resolving, and creating or giving central banks a special role in this, it seems odd. And if anything, it feels to me like it shows how much monetary policy has been politicized, and monetary policymakers seem to be, trying to be seen to be solving every single problem, when in actual fact they have a lot of challenges of their own to resolve. And if anything, so we're reminded of Friedman's presidential address in 1968, when he pointed out, look, we should know what the limits of central banks are. So it's not all about what central banks can do. There are limits to what they can do. And on the real side of the economy, they can't fix the real side of the economy. Their mandate and their main job should be thinking about price stability. And I think the danger here is that central banks getting so caught up in all of these micromanaging things that they forget what their main task is. And in fact, you could argue that if the central banks are going to make a really important contribution to the climate change challenge, they could do so by bringing about sort of price stability that allows people to make investment decisions in a way that will, improve the prospects for adapting to the climate challenge that we have. So I'm very anxious about central banks wandering out of their core mandate, into issues that really should be dealt with by fiscal policy and should be dealt with by society as a whole.
Right. I mean, that's right. I mean, the whole point of central bank independence was to remove this politicization of monetary policy and central bank thinking. And what we've seemed to be doing with these policies is, as you quite rightly say, moving the central bank into a political sphere that we really, or they really, should not be involved in at all.
Yeah, exactly. And this is the kind of sort of paradox of the situation we're in, where we've apparently created apolitical central banks, but they've become even more political in recent years, outside of this inflation discussion. I think the most worrying aspect of the recent behavior of central banks is how little they've understood the inflation process. And so, if anything, stick to your knitting, as I think Boyter put it once. They really should be sticking to what they do best, and really, understand what they're supposed to be able to understand, and not wander into different areas. But I feel old fashioned, though.
Couldn't agree more. I absolutely couldn't agree more, and neither could the institute. To follow up on that, being a monetarist or broad monetarist institute, we're obviously more following a less discretionary policies, monetary policies, and more rule-based monetary policies. Is that something that you think is the right way to go, or now that we have this discretionary monetary policy, it's going to be very hard to move into any kind of different regime?
Yeah, well, I think so. If I were to think about, if I was on the MPC now, for example, or even the governing council of the ECB, right, I'd be looking for thinking about a set of a sort of policy framework that I would use to employ in my thinking, that would be that would give some discretion, but would also have a sort of a clear sort of set of macro financial variables that I thought we should be thinking through and targeting on a regular basis, right? So, I mean, if I were, gun to the head, forced to come up with a way of managing policy now, I wouldn't go so far as to a completely rules based system such as Friedman's monetary targeting, but I would try and embed targeting of balance sheets more generally, not just the monetary aspects of balance sheets, but thinking about the overall balance sheet of the private sector as a key input to the decision making process. And and so, in a sense, what I'd be arguing, or what I'd be advocating, would be almost balance sheet management of the private sector to allow or set policy in a way that allowed private balance sheets to unfold in a way that was consistent with price stability and didn't develop sort of underlying financial vulnerabilities. So I would certainly move in some direction towards some sort of rules-based thinking, but I would always retain the flexibility to react to the information that we have, such as the pandemic and so forth, which you can never prescribe for in advance.
Could I take away from that that you would be an advocate of more macroprudential regulation on capital ratios and liquidity ratios? Is that the route you think is the better route to go? Am I interpreting your words correctly?
No, I think it's more that central banks should be interested in the overall asset prices and monetary aggregates and liabilities of the private sector in the aggregate. And it's less macroprudential. It's more just, look, if equities and house prices go up, households are feeling richer, they will spend more money. You are more likely to get inflation driven above target. And so, you'd almost be reacting to financial stocks. So I think, if we think about Taylor rules as they are laid out traditionally, and that sort of have continued to be popular, one of the inputs is the output gap, which we don't observe in real time. The other input is inflation relative to target, which may be expectations or otherwise. I mean, I would be inclined to say, okay, scrap the output gap. We don't know what it is, but we do have a better read on balance sheets in real time, or relatively decent real time data. So if you think about the balance sheet of the household sector, which is, if it's weak as it was in the post GFC decade because of the housing market challenges, then that would point to policy needs to be loose in order to improve household balance sheets to get inflation back to target. The corollary of that would be post-pandemic, strong balance sheets, high monetary aggregates, rising house prices would feed spending and inflation above target. So there you'd be saying, okay, policy needs to react to the strength of household balance sheets to try and control asset prices. So it wouldn't be just reacting to that, but at least that would be the key input. So I guess I'm arguing Friedman monetary aggregates, but you need monetary aggregates, and then you need all the other major inputs to the household balance sheet. Speaking of which, the US has great data on household balance sheet. We don't get as good data for the Eurozone or the UK. So, in a way, policymakers in the US are much better set up for this type of framework.
Which kind of leads nicely onto the next question I was going to ask, that while the ECB can extend broad-based liquidity support to solvent banks, they cannot support insolvent banks, firms or households. This requires, a fiscal response from the individual governments. But if, as many expect, the Eurozone enters into a recession, I say many expect, I think that's a fair case to make. Do you think this will elicit a more tolerant response from the ECB, and will they have to accept a slower return to the inflation target, more than the medium term, which has never really clearly been defined?
No, I think ultimately the ECB is a pretty conservative institution. So I don't think they're going to react to these financial issues, except insofar as these financial issues then feed back onto the real economy, which would be through higher unemployment, falling output, and then wage growth and inflation. So I think ultimately, if anything, they may not pay enough attention to this stuff. So I actually think these guys, the governing council, are on average much more conservative than they have been over the last decade. When you think about Draghi, the Draghi era, everything was dovish. Everything was a reason to do more monetary policy or loosen monetary policy. I think that is not a true reflection of what the governing council is on average. And I think what's the difference between the Draghi regime and Lagarde is that Draghi was basically the pilot, and he made the decisions, and everybody else had to just get carried along with him. But the Lagarde, she's very much a consensus builder, so she looks for inputs from the other members of the governing council, and I think that's we've seen that the Hawks have developed more a stronger hand, as it were. So I think if anything, they're more hawkish than we think.
And that's something that you've written recently on for Exante Data. I saw a piece that you put out on how there is discussion is allowed, and the voices of the general council are allowed, but when it comes to the press conference and the announcement, then they all have to be reading off the same hymn book.
Hi. Yes. So the yeah the I mean, this is what we that has been reported, right? That she said, look, well, I'll give you more input to the process, but once the decision is made, you all have to stick to that. And I think they have been reasonably good after the fact at defending the decisions that have been made. I think we may be seeing some cracks in that now. But it's interesting that the Doves have been pretty good, as it were. But the Hawks are the ones who are starting to sort of push back on what happened in the last few days. Um, but I think in general they've been reasonably good on defending the decisions that have been taken. The problem they have is that in the lead up to meetings, it becomes a bit of a free for all as they all try and position themselves for the meeting, and so it's just before the meetings that they're most confused.
Yes, yes, it was very confused. Um, in light of the pandemic, global supply chains have undergone significant structural changes, leading to a shift towards domestic production. This shift is expected to enhance the resilience of economies against the future supply shocks, of course. However, such actions may lead to increased production costs in the medium to long term. Considering these factors, do you believe that we are heading towards a period characterized by potential upside inflation risks, which may require more forceful measures from the ECB to future supply shocks?
Yeah, well, I mean, I buy the argument, right? So I think compared to the last decade, there's probably at least five forces that are different structurally that could feed a sort of higher inflation on average. Actually, most of them will feed higher average inflation, but there is one notable possible downside. So one of them is this deglobalization and reshoring narrative. Then, of course, we've got stronger balance sheets post pandemic, so we've kind of moved away from the post GFC and post Eurozone crisis situation. We've got structurally higher energy prices in the Eurozone. So even though prices are way lower than they were last winter, they're still, I think, 3 times higher than the pre-pandemic period. So structurally, these are all arguing for sort of higher average inflation rates. And then, of course, there's the climate change and adaptation set of issues, which itself requires investment, which should be inflationary, at least temporarily. And then there's kind of one wild card, which is the artificial intelligence sort of revolution that could be happening. Again, this may bring higher investment near term, but in longer term, it could bring sort of structural changes in the labor market and productivity gains that could actually be deflationary. So these are the things that the governing council and other central banks have to unpick. And so we're in a kind of a tricky world in terms of weighing them all up. The I think being aware of the risks is one thing, but reacting when we don't have the data yet to be sure that this is happening is another. And so it's very difficult to be sure that this is definitely ongoing because in a way we're undergoing the disinflation post pandemic. So we could end up undershooting inflation targets at some point, in which case these arguments will start to look a bit silly. But I think the key is that the central banks have to be aware of it, and then maybe the most interesting set of issues from the perspective of thinking about um, the global conjuncture at the moment relates to the sort of, if you like, the global saving investment balances situation, right? So what is our star, or what is the average real interest rate that the central bank should be thinking through? And one possibility is that our star is not set by these structural factors in individual economies, but it could be set by the global saving investment situation, and in particular by China. And what we don't know yet, what is the great unknown, is how China reacts to its current slowdown. If it accelerates consumption to grow the economy endogenously, that involves a lower savings rate globally and in China, then all of a sudden you've got higher investment and higher and lower savings, and ex post these have to be equal. And so one way they would have to be equal is through a higher interest rate on average. So maybe the really interesting issue is how the global saving investment balances are brought to equilibrium, on how they're going to add up over the next decade. And I just think we don't know the answer to that yet. Nobody knows what China's going to do. And if
No.
we did know, then then we would then that would be all of our focus, I think.
So this is the argument of this shift in the savings glut from China and oil-rich countries to the West, and then putting downward pressure on interest rates.
Exactly, and I think that the idea that central banks from the first decade of this century would, EMs were accumulating reserve assets, and there was a relentless bid for U.S. Treasuries by not only China but EMs in general, and that in the last decade, obviously, that was the first decade of this millennium, and then the second decade was characterized by central bank QE buying goees. So you've had a relentless bid for fixed income over 2 decades now from central banks, and a shrinking relative to the counterfactual, a shrinking of the free float, as they call it, the amount of govies that the private sector and the amount of duration risk the private sector has to take. So that is all reversing now. So it's impossible to see most of the major central banks buying at the size that we've seen in the last 2 decades from emerging markets in the period ahead, and QE is going into reverse. So we're moving into a world where, from a stock perspective, duration that the private sector has to hold is going to be way bigger than it has been over the last 2 decades. And then from a flow perspective, the surpluses in China and other emerging markets who didn't want to face the consequences of running a deficit on current account, if they begin to grow their way out of their situation and raise consumption, so there's no longer the surplus counterpart to the deficit in the US. And in Germany, they've got the structural manufacturing challenge. And if they become a service-led economy and start to change their structure towards services and stop being a surplus agent, so if they start to become a service economy, then you've got no surplus economies to be the offset to the US deficit and the UK deficit. So if that becomes a structure of the next decade, then we're in a different world from a macro trading perspective. So it's something to look out for. Nothing's decided yet, but we're at a crossroads, as it were.
Yes. A lot of talk recently of the weakening euro. And again, we saw the hike yesterday and the euro weakened. I think it slightly stronger this morning. How do you think the weak euro weighs on the policy outlook, if at all?
Well, it's a problem insofar as, especially in a period of higher energy prices, which we seem to be witnessing at the moment, that this feeds into higher headline inflation. So it is a problem for the ECB in that respect, but it is the natural counterpart to the weak, sort of structural and the cyclical challenge of the manufacturing sector, and Germany in particular. So at one level, it's the necessary part of the necessary adjustment process. On the other hand, it's going to feed higher headline inflation, and that could become embedded in higher wages. And so it becomes a problem for the ECB. So, I mean, I think a decade ago, again, under Draghi, you kind of know that every shock was a reason to do more monetary policy. And so a sort of a weaker euro would have arguably lowered real incomes and then required a monetary policy response because it would exacerbate the depression. But everything's flipped now. So a weaker euro means that there'll be higher wage pressures and higher core inflation pressures further out. So it is a problem for the ECB. It's very different to the Eurozone, the period after the Eurozone crisis.
Okay. So, Chris, I don't want to keep you too much longer, so I'm going to ask you one final question. With hindsight, what do you think the ECB could have done differently in its response to the pandemic?
Well, I guess to be honest, I think they've probably done okay for the first year or so of the pandemic. I mean, the initial, we're not here to close the spreads discussion, and the initial paltry asset purchase program expansion was obviously a problem, but they fixed that within a couple of weeks, and so that was ultimately they did okay. I think the main challenges they've had is the inflation consequences and dealing with that. And so I think that the issue really is that they needed to be better at the inflation forecast. I don't think they fully integrated the monetary consequences of the pandemic response. So if they got ahead of the narrative and built on the monetary aggregates more and built on the inflation forecasts that were ahead of the curve so basically they were producing inflation forecasts that within one print were out of date. So I mean, they update them every quarter, and they were out of date within weeks. So they had problems with inflation forecasting, and I think the danger is that in the same way they had problems on the inflation on the acceleration of inflation, they probably have problems on the way down. So I don't trust the inflation process. So if I were at the ECB, that's where I'd be focusing a lot of my attention. But that also applies to the Bank of England and other central banks. So it's not an ECB criticism as such. Um, Otherwise, I think there were people who say they didn't react quick enough on the hiking. I think they could have reacted the speed they did, but by being better with communication on what was happening on inflation. But the combination of constantly playing catch up and not reacting to a proper inflation forecast has been a problem for them. So I think that would be what I would look to change.
Excellent. Chris, thank you for your very detailed and in-depth analysis of what's going on within the ECB monetary policy. We really do appreciate your time. I know how busy you are. So thank you very much for that. Everyone, this was Chris Marsh, Chief Economic Advisor at Exante Data and blogger under the General Theorist. Please log on, follow them, get their information, get their research. It's the best that you can get out there. Thank you very much.
Thank you, Damien.